Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I love to get his insights on the oil and natural gas markets. He is founder and chief analyst at the Energy and Income Advisor, Elliott Gue. Thank you for joining me again.
Oh, thanks for having me on the show. Always a pleasure.
And Elliott has over 20 years of experience covering oil and natural gas stocks. This is all he does, folks, and he does it very, very well. We're talking site visits. He looks at company presentations. He listens to all the investors' conference calls. He does all the work. And that's why his paid newsletters have a lot of paying customers for many, many years now. So we're recording this interview on Friday, March 8th, 2024. West Texas Intermediate is at $77.85. Oil prices have been in a trading range for months now. U.S. natural gas prices over the last couple of months, they've crashed. Hopefully we have a bottom soon. They're at $1.81 though. I think the rig count's probably going to start falling again, even more in the not too distant future. Elliott, I want to get your thoughts on oil supply demand fundamentals. We had some really interesting comments from another oil expert, this guy named Paul Sankey. He said that the Saudis are subsidizing oil prices now to keep them propped up at these levels. Do you think that that's the case, or do you think that the oil supply demand fundamentals are different than what he's saying, how the Saudis are intentionally subsidizing the market to prop up prices?
Well, as far as the oil supply demand fundamentals are concerned, I think towards the end of last year, there was this idea out there, and it was something that the IEA and other groups, the International Energy Agency, other groups were sort of promoting, or they were making it their forecast in their monthly oil market report, and that was that you have into 2024, what they saw was slowing demand growth. So not shrinking demand overall, but basically we had, 2020, all the economic lockdowns, this collapse in oil demand. And then we had a recovery in 2021, 2022. And their view has been that, oil demand would continue to grow, but it would slow dramatically, that growth. On the opposite side of the equation, they saw very strong growth in non-OPEC supply, particularly from the United States shale, Brazil, and Guyana in South America. So the Americas really contributing a lot of that. And so they saw balances, and what I mean by balances is the supply-demand balance before OPEC, right? So when you look at the global oil market, or when I look at the global oil market, what I like to look at is, what are the expectations for overall oil demand? What are the expectations for non-OPEC supply? And then, what's the call on OPEC? The amount of oil that OPEC needs to supply to the global market to sort of balance supply and demand. Now, theoretically, if OPEC supplies less than the call, you're going to get a drawdown in global inventories, oil and storage, right? And that tends to be bullish for prices and vice versa. And so they saw pretty loose balances through the first half of this year and really into the second half of this year as well. But that was one of the reasons why oil was so weak. If you remember back in December, West Texas Intermediate dipped under $70 a barrel, and we're now up in the high 70s to around 80 over the last few days. And that view hasn't really panned out. And the reason I say that is what I like to do is I like to look at some of the indicators we have of physical oil balances, in particular here in the United States. And, what we're seeing is the backwardation in the futures curve is been getting steeper. And what I mean by that is there are futures traded for oil delivery every month of the year, right? So you can contract for oil delivery in April 2023 or May or June, or January 2025. So right now you have the current price of oil, the front month spot contract, the spot prices or the front month futures contracts they're around $77, $78 a barrel. But if you go out, say 6 or 12 months in the future, you're looking at prices that are $4 or $5 a barrel less. This is called backwardation. And typically when the oil market is in backwardation, that's the oil market's way of telling market participants that it needs more supply right now. Because if you think about it, if oil market's in backwardation, if you can sell oil at a higher price today versus the price in 6 or 12 months, there's absolutely no incentive. In fact, there's a disincentive to store oil. And so backwardation has generally been growing in oil markets so far this year. Crack spreads, which are a measure of refining profit margins, have generally been above the seasonal average, which means that refiners are earning more profit taking oil and creating products like gasoline, diesel fuel, and jet fuel. That's also typically a sign of buoyant demand because the crack spread is based on the relative price of oil and refined products that consumers and companies use, right? Which are gasoline, distillate or diesel, heating oil, jet fuel, et cetera. So, right now, we're not seeing a build in global inventories as many people were talking about towards the end of last year. We're seeing quite the opposite. So I actually think the supply-demand fundamentals are a lot tighter, meaning more bullish for oil than most people fully appreciate. The other factor that I think a lot of people are getting wrong is the U.S. oil supply, and in particular shale oil production. If you look at the EIA figures, so the Energy Information Administration figures, they're showing very rapid growth, but most of that's a mirage for two reasons. One is that the EIA, which is part of the Department of Energy, the U.S. Department of Energy, changed the way it calculates crude oil production in June of last year, but didn't really adjust figures going farther back in the past. So when you're comparing current oil production to, say, oil production a year again, you're really comparing apples to oranges. The second factor is that last year we had a lot of merger and acquisition activity in the energy space, particularly in the Permian Basin here in the U.S. So everybody knows about Exxon Mobil acquiring Pioneer, but I'm also talking about the private oil and gas producers. A number of them in the Permian Basin were acquired by larger players. So we had Occidental acquired Caprock. We've had 6 or 7 of the largest private producers, or the top 20 producers, have been acquired over the past year. Now, what these privately held companies do before they get acquired is they tend to try to ramp up production. And the reason is that typically when you're valuing a private company in the energy business, you value it on the acreage they have, so their net acres that they hold, and what we call flowing production. So basically, how much oil and gas are they actually producing right now? So they have every incentive to dress that up, to kind of window dress that ahead of a deal. So we saw very aggressive drilling activity from these private producers, particularly in the first half of the year into the summer months. And then it kind of collapsed thereafter, because once these companies got that surge of production, dressed themselves up for sale, attracted acquisition offers, once they're acquired, immediately the acquiring company cuts drilling activity, cuts completion activity, fracturing activity, and tries to generate free cash flow. So what you got was this kind of artificial boost in U.S. oil production from all that drilling activity in the first half of last year. That doesn't start showing up in actual production until the end of the year. And now I think this year we're going to see a hangover from that, because a lot of these companies, once they're acquired, you're seeing lower drilling activity. Yes, Saudi Arabia and other OPEC members are reducing production to keep the oil market balanced, keep supply and demand balanced. But I think that the idea that there's going to be this massive oversupply unless OPEC cuts a lot more is wrong. OPEC was producing pretty much max out back in 2022. Ironically, when President Biden and others were over there in Saudi Arabia trying to convince the Saudis to pump more, my view of the matter is that Saudi Arabia was already pumping as much as they ever have in history, and as much as they're comfortable pumping. If they pump too fast, they're going to damage their oil fields, or they're going to eliminate their spare capacity, which basically eliminates their power within OPEC, their power to control swing supply. So now they're pumping a lot less, and I think less than they would want to longer term. But as oil demand keeps growing, as U.S. oil production slows down, I think ultimately they're going to be in a position to take back some of those cuts and start increasing their production again. And I just don't see this sort of permanent glut that a lot of people were talking about late last year. I don't think oil prices are going to slip down to, say, $60 a barrel or under. As a lot of talking heads were mentioning late last year, unless you have, this sort of massive global recession that destroys demand, then you could see a dip in oil prices. Other than that, I think you're more likely to see $90 a barrel in the first half of this year in the US, the WTI oil market. That's more like 95 plus for Brent. Than you are to see, consistent sub 70 pricing on crude.
Yeah, I agree with a lot of that analysis. I think it's simplistic what that other oil analyst said, how the Saudis are subsidizing the oil market. It's not factoring in how a lot of these oil producing countries with national oil companies like Saudi Aramco and others, their government budgets for their social program spending, for government funding, they're so reliant on oil revenues. So they just talk about how the Saudis should produce oil at max capacity and not keep any spare capacity, just flood the market, maintain market share, knock oil prices down and gain market share again, like in 2013, 14, 15, like what the Saudis did back then. And the Saudis can run that for a couple of years or 18 months and they'll be fine. I mean, we're in an inflationary environment. All these governments have massive amounts of inflation too. They have higher interest rates to deal with, government debt. So they don't want their tax receipts, their oil revenues to collapse like that. I don't think the Saudis want to run the oil price below 50 and go through all their foreign exchange reserves, trade surpluses. They're very happy, I think, if oil prices went to above 80, so 85, 90, 95 a barrel. Maybe if it goes to 100, that's too high. They want to keep it kind of in a sweet spot to where there's not substitution for oil and they can still make a profit and fund their government.
Yeah, that's exactly right. I think a lot of people don't understand that, Saudi Arabia, their social spending that they do is sort of mission critical, if you will, right? Because there's a large population of Shiites in Saudi Arabia. It's a minority, but it's a sizable minority, right? And a lot of the and they tend to be less wealthy per se than the majority Sunni population, right? So a lot of the social spending is directed at keeping people happy, right? How did Saudi Arabia avoid the Arab Spring? Remember the Arab Spring back 12 years ago or so? Riots and whatnot and civil unrest that occurred in a lot of countries, North Africa and also in the Middle East. The way they did it was by spending a lot of money and keeping people happy. Right.
Subsidizing food, right? Because
subsidizing food, subsidizing housing, subsidizing energy. Right. So it's not that they're doing it just out of, the kindness of their heart or just because they feel like it. They're doing it because that's the way they stay in power. I mean, it really is mission critical for the ruling, the royal family and the ruling classes in Saudi Arabia to maintain a lot of that. It's not really optional.
And you mentioned spare capacity too. I mean, would you say that in OPEC, the Saudis are really the only one with a sizable amount of spare capacity? Because a lot of the other OPEC and OPEC plus countries, aren't they way below their production quotas? Yeah. They're not even close.
Yeah, I mean, there are a handful of countries that have spare capacity. Saudi Arabia being the largest. There's probably a little bit in countries in UAE and Kuwait and countries like that. But most of the other countries within OPEC, and particularly a lot of the African countries in OPEC, they really don't have the ability to increase production much beyond what they're already producing right now. A lot of them have older fields that haven't seen a lot of investment for many, many years. And the best they could hope for is maybe to stabilize production declines, but not really increase their production significantly. Saudi Arabia is one of the only countries with significant spare capacity, and they're probably the most sizable spare capacity out there. And, that's what gives them power in OPEC, right? Because they can threaten the other companies and countries in OPEC and say, if you don't fall in line, we will flood the market. We will send oil prices plummeting. Everybody knows they can afford to do that for some period of time. And though I would say I agree with the points you made, I mean, in 2014, Saudi Arabia was facing when they made the decision to basically flood the world oil market and send prices tumbling, they were facing a very different threat, right? They looked out in the world In fact, the Ali Al-Naimi, he wrote a great book. I think it's called Out of the Desert. I believe it's called Out of the Desert. It's a sort of biography or autobiography, if you will. He wrote it himself. He was the oil minister at the time. He explains why they did what they did right there. And some people, I don't know whether they just don't believe him or whatever it may be, but the reason they did what they did is they looked out around the world and they saw two things. They saw that shale producers were increasing their production basically every month. The shale boom was underway, and Saudi Arabia was basically paying for that, because when the shale producers ramped up production, Saudi Arabia would cut its production to keep the price up. And then those high prices encouraged ever more drilling, ever more production activity from U.S. shale. So they basically paid for the whole shale boom, right, by artificially keeping prices high. And they realized that they could cut production by 50%, and the shale producers would just fill the gap. The same thing happened to them back in the 80s, by the way, back in 86. They saw global production rising too fast. They realized they were subsidizing it by propping up prices. The other thing they saw was that a lot of OPEC members were basically just doing whatever they wanted to do in terms of production. They were just ignoring, whatever decisions, quote unquote, were made at the OPEC level. And so they wanted to punish everybody and sort of bring an end to this unrestrained production growth. But that's not the case right now. There is no unrestrained production growth. U.S. shale oil production is growing, but it's growing at a fraction of the pace that we saw back leading up to that 2014 collapse. Most of the production is only a little higher than it was back in 2020, say. So I don't think they're going to react in the same way at all. They realize that U.S. shale producers are no longer seeking growth at any price. They're 100% focused on cash flow. Look at any of the big shale names out there. Names like Pioneer, which is of course being acquired now, but names like Devon, names like EOG, they're all focused on producing free cash flow, paying dividends, buying back stock. They're not focused on going out and achieving 5 or 10 or 20% production growth. I agree. It's a very different world, and the Saudis are unlikely to flood the oil market over the next few years. I think that they're likely to try to maintain oil prices around where they are, or preferably over time higher than where they are. They need probably low mid 90s to sort of balance the budget and produce some excess cash, and I think that's what they're going to get longer term.
Yeah, I agree. And I think if there is a global recession, we have a stock market crash, if oil prices temporarily fall, let's say below 65 to 60 dollars a barrel, or maybe even mid to high 50s, I think the Saudis would even think about cutting more. So that would go against what this other oil analyst is saying. I think the Saudis would say, we need a higher price. We have all this inflation in our system. We have a lot of government debt, like most of these other countries. They want to balance their budget. They would say, we're going to cut, because the shale oil production is not going to take our market share, because they're not, with interest rates where they are. I mean, like you said, a lot of these mergers and acquisitions, I don't see a lot of these post-mergers and acquisitions, they're going to start rapidly growing again. I think it's the opposite.
Yeah, no, it definitely is. If you look at any of the companies that have made acquisitions, Diamondback, the symbol's FANG, recently acquired one just, I think on February 12th. They're all talking about basically cutting spending, cutting CapEx, bringing costs down to the parent company's average level and generating more free cash flow. They're not talking about, trying to grow production on this new acreage. It's not really adding, to U.S. oil production. If company A goes out and acquires smaller company B, that's not adding to total U.S. oil production, right? It's just shifting ownership of the existing production into smaller number of large hands. And, that's typical, right? I mean, that happened in all the plays in the U.S. and everywhere. Gulf of Mexico offshore Gulf of Mexico, shallow water Gulf of Mexico started out as a lot of little producers. And then over time, the big boys come in and acquire all of that, right? And consolidate control. And they don't do that to show a lot of production growth. They do that because they want to generate lots of free cash flow. That's their whole business model. I think that's you're not like I think that you're not likely to see huge amounts of production growth from the U.S. shale arena, say over the next 5 to 7 years, compared to what you saw during the shale boom years. You probably see some modest growth or steady growth or a plateau of production over a long period of time, but you're not going to see this unrestrained growth that we saw, back during the boom years. That's really just not how it works.
Well, especially with let me add to your point there, especially with natural gas where it is right now. I mean, the incentive there, a lot of, for our listeners out there, for the Permian Basin wells, a lot of the a lot of the energy production, is a mix. It's not just light, sweet crude oil. It's natural gas liquids. I think a lot of these shale oil wells in the Permian Basin, they have 30% natural gas and a lot of natural gas liquids. So unless those prices are also doing well, there's not the incentive to keep bringing on new production.
Yeah, I mean, it depends on where you are in the Permian. Generally, the Midland Basin, which is the part that's totally in Texas, it's further to the east, sort of in central Texas. That is it's oilier, so you're going to get higher amounts of actual crude oil and lower amounts of, say, natural gas. But I mean, you go out to the western part of the Permian, on the border of sort of Texas and into New Mexico, some of that is very gassy. So you're going to get much higher natural gas and natural gas liquid cuts relative to oil. And yeah, the economics of natural gas and natural gas liquids is a totally different animal entirely. You mentioned low natural gas prices right now, and it's absolutely true. And we are seeing, companies respond to that. Just a few days ago, about a week ago, I guess, Chesapeake came out. EQT came out and said that they're shutting in natural gas production from the Marcellus because there's too much gas out there, to kind of keep supplies from getting out of control. And Chesapeake, a few days before that, actually came out with, what I think is kind of a game changer, not to be too dramatic, but what they're doing is they're actually, you've probably heard of, it's been out there for a while. A lot of gas drillers, what they do when gas prices are low is they drill wells, but they don't fracture them and put them into production. And so we call those drilled uncompleted wells, or DUCs. So that's been around for a long time. And Chesapeake is building some DUCs as a result of low gas prices. However, I think what's more interesting is they're doing what are called deferred TILs. So TIL is an acronym for turn in line. A turn in line is an industry term which means converting a well into actual sales of hydrocarbons, right? Whether it's oil or gas. And so what they're doing is they're drilling wells, they're completing and fracturing the wells, right? And then they're not producing, right? And they're saying we're just going to build these wells that are pretty much ready to go, right? While gas prices are low, and we're not going to start turning them on until gas prices recover to a more reasonable level, which for them is, probably, $3, right, or so. And so, they're actually, over time, that's going to mean a lot of gas production that would have hit the market in a normal market that's not going to. And that's, I think, already tightening up the market. Now, it's not going to do much between now and May, right? But as we start to move into summer and into next year, if you look at the futures for gas price for delivery after the middle of the year, they're already much higher, and they've been going higher. So, while everybody's focused on the front months, the longer term futures are actually pretty buoyant. And so, I think that, shale companies are a lot more rational today, for lack of a better term, than they were on both the oil and gas side. A lot more rational today in the way they operate than they were during the boom years. When prices are low, they respond by cutting production, building drilled uncompleted wells, deferring TILs now. On the gas side, on the oil side, they cut their drilling activity. They cut their capital spending. They focus totally on free cash flow. They're not, either on the oil or gas side, most of them, especially even on the gas side, are not just producing for the sake of showing growth.
Exactly. So when the Federal Reserve Bank had zero interest rate policy, some of these shale boom companies and natural gas companies from like 2009 to like 2014, I mean, they were kind of operating like Silicon Valley unicorn tech stocks where they're focusing solely on drilling new wells. They didn't care about prices, all about production growth. So all their investors' presentations were about growth, growth, growth. They weren't focusing on profit margins, free cash flow. The pension funds, the institutional investors were all writing them large checks. And now you have like the exact opposite scenario because where interest rates where they are, larger investors are saying, why should I go fund some of these riskier companies that might not have a low production cost when I could just earn a quote unquote risk-free return in a short-term U.S. Treasury or money market fund? So that's competing with cost of capital. And then the pension funds are not giving the oil companies, the shale oil companies, those types of checks for artificially cheap capital. So the companies have to be more efficient. They're being forced to be more efficient. And then the capital's not going into the oil sector unless you're like an Exxon Mobil or Chevron and you're going and looking for acquisitions. But like the generalist investors, like the institutional investors and the pension funds, they're not investing into oil companies like they did during the shale boom.
No, and everybody's focus now. The focus is always on costs and how to get more costs out of the system. I mean, on the gas side, Chesapeake is acquiring or planning to acquire Southwestern, become the largest natural gas producer in the U.S. What did their investor presentation around that acquisition focus on? It said, well, Southwestern's costs in their key operating areas, which are the Haynesville of Louisiana and the Marcellus Shale of Appalachia, are a little higher than Chesapeake's, right? Their capital efficiency is a little lower. If we can just bring those costs down to the Chesapeake average, because the acreage is right next to each other, we can generate, hundreds of millions of dollars of synergy, over the course of a year, $1 billion plus of synergies. And it just, but yeah, you're right. I mean, if you go back 2013, 2014, all the way really up until 2016, 2017 as well. You go to a lot of these energy industry conferences, what was being talked about is, well, we have this new acreage in such and such a place, and we're drilling wells in such and such a way, and look how much we're producing. Look at our production rates and how much we could grow production over the next 5 years. And the reason they were focused on that was because that was what investors wanted. If you go back to that time and you look in, say, 2013, if you take a bunch of energy producing stocks, U.S. shale producers, and you line up their annual stock returns with their production growth, it was pretty close correlation. The faster they grew production, the higher their valuations, the better the stock did. But that's a historical artifact, if you will, now.
Now, for natural gas, what do you think is a safe way? Do you think some of these pipeline companies that have the majority of the pipelines in the Permian Basin, like a ONEOK, a Plains All America, an Enbridge, do you think that those are safe ways to play this natural gas, where natural gas is going to bottom, I don't know, in the next 6 to 8 months, and the natural gas is going to rally? Do you think the pipeline companies are a safe way to play the rally in natural gas prices?
Yeah, I mean, we play in Energy and Income Advisor. We are focusing on two ways to play natural gas, and we're sort of bearish on another way. A lot of people ask me about these. I mean, let me start with the wrong way, in my opinion. A lot of people ask me about these natural gas ETFs, like UNG, or BOIL is even worse. It's a leveraged play on natural gas futures, actually. I think that's absolutely the wrong way to play it. I won't go into all the reasons here, but those are all focused on short-term futures price of gas. So BOIL, I think, now is trading the May 2024 futures, and UNG, I think, is in the April 2024 futures. Gas prices are not going to benefit from anything that's happening on the supply-demand front over the next few months. The benefits we'll see from lower production growth, from cutting in activity levels and all that, won't really accrue, or from increased LNG exports next year. That won't accrue until late this year at the earliest, and probably early 2025. I do think some of the high quality producers are a good play. I would highlight names like EQT. I think we've talked about that before when I've been on the show.
Yeah.
And also, Chesapeake would be another name. And what you just mentioned, some of the midstream players out there that have natural gas or natural gas liquids type pipelines or processing plants, assets like that. They're going to see reasonable volume throughput through their systems over time. They have a lot of contracts in place that sort of guarantee them a level of revenue. I think you have to see more infrastructure built out in certain key areas of the country to serve growing production from fields like the Haynesville Shale of Louisiana that is going to feed LNG on the Gulf Coast. So I think a lot of the midstream MLP type names, names like I said, Energy Transfer, Enterprise Products Partners, they're a safer way to play natural gas that doesn't have a whole lot of commodity price exposure. You probably will have to be a little bit patient with some of the producer names because if gas prices go down 4 or 5% in a single day, or 10% as they have front month futures, a lot of them get hit by association a little bit. But what we have seen this year, which I think is very encouraging, is that even though gas prices have been terrible in terms of the front few months of futures, the gas producer stocks have actually done reasonably well. We've seen significant upside in names like Chesapeake, EQT, since January, even though gas prices remain, very depressed. I think those are all valid ways to play it. I would just avoid any of those ETFs that focus on the futures.
And the U.S. just surpassed Qatar as the world's top liquefied natural gas exporter, despite the legislation that Joe Biden put in place. There's a lot of liquefied natural gas export facilities being planned. I think I just saw a news story that the Saudi Aramco and I think United Arab Emirates or one of the other OPEC plus countries is also going to be investing in one of the liquefied natural gas export facilities here in Texas and in Louisiana. So this trend is going to continue, especially where it's kind of an arbitrage where you can take the cheaper U.S. natural gas prices here and then you can turn it into and sell for the liquefied natural gas export facility and then sell it at a much higher price in another country.
Yes, that's exactly what it is. I mean, right now in Europe, for example, Netherlands TTF, which is Title Transfer Facility gas, is around $8.50 a million BTUs for the April delivery. And as I said, and as you said, I mean, U.S. natural gas is well under 2. It's like 180. So for April. So, it's a huge pricing advantage. And I think a lot of people make the mistake. One mistake I hear a lot of people make anyway is that, well, if we get a series of warm winters, Europe doesn't need the natural gas, or alternatively, they're building out their wind and solar capacity. They don't need the natural gas. But I mean, I think what a lot of people forget is that a lot of natural gas is used in industrial applications. So factories, chemical production, not necessarily just to heat your house, right? So, Germany has seen their manufacturing and industrial output has just collapsed to levels we haven't seen since the 1990s. And the reason is because of the still ongoing energy crisis. So, a lot of people think, well, because gas prices are off their high, the problem has been solved. It hasn't. Germany is in a recession, and their industrial sector has been in a recession on and off for 3 years now, right? It's because of the ongoing energy crisis. Energy prices are too high for most European countries to grow.
I think I saw that a lot of these energy agencies are projecting, and I think also the statistical analysis, British Petroleum doesn't do it anymore, who I think they spun off the company. They're
Energy
projecting,
Institute, yeah.
Yeah, they're projecting the natural gas demand by 2030. They're projecting it to grow by 50%. I mean, a lot of that, though, is coming from emerging markets, China, India. I mean, they're building coal-fired power plants still, but they're also switching some of those to natural gas.
Yeah, India is another one. It's definitely a trend all over the world. I also would say, okay, the Joe Biden LNG announcement. I mean, it's in my opinion, it's a stupid idea. There's no reason. I mean, in other words, the idea that natural gas is causing an increase in the U.S. natural gas output and production and exports are causing an increase in carbon dioxide emissions is ludicrous. In most cases, U.S. natural gas is displacing coal, which is the most polluting fuel there is, right? And not only in the carbon dioxide side, but also lots of other pollutants, right? Mercury, carbon monoxide, sulfur, acid rain, sulfur dioxide. But I'd also say that it's really a non-event. It doesn't apply to any plants that already have permits, which means that the growth in U.S. LNG exports is unchanged. The outlook is unchanged through till about 2029. And also remember that really what's happening there, in my view, is just bad old-fashioned, if you will, politics, which is that he was under a lot of pressure from these climate groups, right, to do something about LNG. That became sort of the cause célèbre for a lot of these people. So the decision he made is to basically punt any decision on new permits until after the presidential election. But that doesn't mean that, early next year with gas prices a lot higher, that they won't decide to go ahead and approve permits, particularly if, European countries are basically screaming for more supply, which I think is likely, if not this year or next year, certainly within the next 2 or 3 years. So in my view, U.S. LNG exports are going to grow. It's a good thing for the economy here. It's a good thing for the economies of the importing countries because they're getting a more stable source of supply from a more reliable partner than, for example, importing 70% of your supply from Russia, which is what some European countries are doing. And at the same time, you're also getting a good deal for the environment because you're displacing some coal with a cleaner burning fuel. So, I mean, I think I think the growth story is still very much intact.
Energy policy here in the United States is very politicized. So it depends who's in the White House, which political party is controlling the majority of Congress. But yeah, overall, I think natural gas demand is definitely going to grow. Cheap electricity demand is growing. And I think the two best solutions, natural gas is a good transition fuel along with nuclear power, but it takes years longer to build nuclear power plants. So I'm cautiously optimistic that more nuclear power plants will be built now with some of the announcements since November coming out of some of these conferences globally, but we'll see.
Right. And I think one of the things on the nuclear power side, too, that's positive is that, look at a lot of these countries that were, Japan being the most obvious example. I mean, they were talking about eliminating nuclear power from the mix 4 or 5 years ago, right? And now it's just the opposite. They're restarting plants that were idled after the Fukushima disaster, back, 12, 13 years ago. They're going the other way. So countries that had been planning to phase out nuclear power or close down plants are either delaying or canceling those plans. Obviously, there's exceptions to that. Germany, for some reason, went ahead with their plans to close all the nuclear power plants. But there are a lot of positive changes underway on the margin, power plant renewals, ending plans to phase out nuclear power in countries like Japan.
So I want to transition now to some of the comments, blog articles for his paid newsletter and interviews that Doomberg has said recently. They've basically said more or less that oil demand is going to start to peak. And a lot of it is because the U.S. has such an abundance of natural gas liquids and natural gas in the Permian Basin, and that oil refiners will be replacing oil and using instead natural gas liquids, I guess, to make gasoline and some other petroleum products. Now, Elliott, you're unique because you've actually been working and covering these oil companies for many years. You've actually visited oil refineries. Do you think that Doomberg is accurate here that these oil refiners can actually transition completely over and start eliminating the oil that they use for inputs to make gasoline and other products?
The short answer is no. I don't think he's correct. I think that some of what he's saying doesn't make a whole lot of sense to me. If you look at it, for many years, ever since I've been involved in this business or studying these companies, and certainly a lot farther back than that, refiners, energy producers have been blending certain natural gas liquids with oil as a part of their business for at least 30 years now. For example, OPEC has been including natural gas liquid supply in its oil supply, in its global oil supply estimates, right? In every monthly report that they produce. So it's not like this is some new thing. We've been doing this for decades. And all these energy agencies, whether it's the IEA or OPEC or EIA, right? They all include certain natural gas liquid supply in their oil volumes estimates. So it's nothing new. It's been going on for a long time. Now, there have been some changes in the way EIA reports that data recently that I think has sort of fed this view. But I see no evidence from the company's reports that any of these refiners are dramatically increasing the amount of LNG volumes that they consume to produce gasoline and diesel fuel. My other issue with it is that it's essentially, I'm not going to say impossible, because you can do almost anything, but the cost would be prohibitively high. More than half of U.S. natural gas liquids production is ethane, which is basically a short molecule. It's so methane, which is natural gas, is one carbon atom bonded to 4 hydrogen atoms, right? CH4. Ethane is 2 carbon atoms with, I believe, 6 hydrogen atoms. So it's a slightly longer chain of hydrocarbons. Most ethane is used for 2 things, right? If ethane prices are too low, which has been the case a lot over the last few years, most producers just leave it in the natural gas supply. So it's burned just like methane, right? Otherwise, it's used to produce ethylene, which is a chemical used to make certain types of plastic. Propane, right, is the next most abundant natural gas liquid. And those two together account for something like 70% of US NGLs production. Propane is also not really used to make gasoline or diesel fuel. It's used for heat. It's also used in chemical production to make propylene, which is used to make PVC, right, and other plastics. So, most natural gas liquids production in the U.S. is directed at other uses already. The energy content of both ethane and propane is orders of magnitude lower than the energy content in a similar quantity, say, of diesel or gasoline. So they're not really a substitute for oil. In the oil refining process, mostly what gets blended with crude oil. And by the way, crude oil, people talk about crude oil, but crude oil, it's very different in different places, in different parts of the world, right? There are all these different benchmarks out there. But all it is just chains of hydrocarbons, right? Carbon atoms with hydrogen atoms of different lengths. Yep. And what refiners do, right, at their heart, the business is all about taking this oil and you heat it up, right? And lighter molecules of hydrocarbons will rise to the top of a tower where they can be separated from heavier chains of hydrocarbons. And so, your lighter products like gasoline, say, will separate from your heavier hydrocarbons like diesel or jet fuel or coke. So, obviously, it's a lot more complicated than that.
Well, Don't they have to blend? So sorry to interrupt you, but for our
Yeah,
listeners out there, so the Permian Basin oil, that's light sweet crude. The
yeah,
refiners actually didn't like the light sweet crude. They like mixing in heavy sour crude with it, right? Because it's
that's
more
right.
energy dense.
Yeah, it's more well, and there are a few things going on there. I mean, back when I started following the refiners, back in say, the early 2000s or late 90s, the trend globally, which everybody assumed was going to continue, was that the global feedstock for refiners was becoming more heavy and sour, right? So the average grade of crude on the global market was heavier, which does refer to the specific gravity of the oil, but also how hard it is to refine, was becoming heavier and more sour, which refers to its sulfur content. So all the U.S. refiners were developing their ability to refine these heavier and more sour grades of crude oil. So companies like Valero or Exxon, they were all investing to be able to handle these more complex grades of crude oil imported from places like Venezuela, right?
Or Canada, yeah.
Yeah, or some of the oil sands blends and whatnot from Canada, and so they were setting up their refineries to increase their yields of usable products like gasoline and diesel from these heavy sour grades. Along comes shale, and suddenly the U.S. oil supply shifts and becomes a lot lighter. But and companies have done a lot over the last few years. Valero, for example, has invested to be able to refine this stuff better, but they still would prefer to have heavier and sour crude oils in there. In fact, one of the reasons I think I've recommended Valero recently in the service is that, now Venezuela, some of the sanctions on Venezuela have been lifted, which is allowing Venezuela to export heavy sour crude oil to the U.S. again. And Valero loves that because a lot of their refineries are set up to maximize their output with a blend of heavy sour crude oil in there. And I think what you got to remember, I mean, I remember touring a refinery back in, I think it was March of 2009, right? And it was a Chevron refinery outside San Francisco. And, we were going through the whole refinery. And, one of the things they were talking about was refiners, they don't say, well, you know what, we're going to make gasoline out of, natural gas liquids. That's not how it works, right? What they do is they say, all right, on any given day, right? They say, okay, what type of oil is available out there? Could I contract for, a tanker to bring me oil from West Africa, right? Or South America, or the Middle East, or more supply from Alaska or Texas, right? So what grades of crude oil are out there? And then they look at their refinery, right? And they have computer models to do a lot of this, even back then, right? And they say, okay, what can our refinery process most efficiently? What's the cost of that crude? Could we use a slightly or heavier crude, which maybe gets us less yield, but it's cheap enough that it offsets that, right? What could we blend with that crude to make it fit better with their refinery? What are the costs? And they do these calculations every single day for all their refineries to try to figure out how to maximize their profits, right? I mean, it's totally logical. So they don't just go out and say, you know what, we think that natural gas liquids production is very high, so we're going to start using more natural gas liquids to produce gasoline. I mean, that's just not how it works. These refineries are set up to refine certain types of crude oil. They have different complexities, capabilities, and supply in different parts of the country is very different. So they're always going to look to maximize their profits. Now if they were all to start buying one type of crude oil, one type of hydrocarbon, obviously they would quickly drive up the price of that hydrocarbon and it would no longer be profitable. It's not like they're going to sit there and continue buying a really expensive grade of crude or some product, right? If their profit margins are getting crushed. I mean, refinery it's very much a business of managing your input costs and your feedstock to generate as much profit margin as you possibly can, given a obviously very commoditized market, right? I mean, the
Well, you
gasoline they sell is the same. So, they're trying
Well,
to,
it's seasonal, right? You said in the emails because you sent me long emails describing this. I mean,
yeah,
there's regulations and there's seasonality. So the summer blends are different from the winter blends. So the refiners have to switch over to that. So they can't put what natural gas liquids and butanes. They can mix some of that in certain seasons into that, and then in other seasons they can't.
yeah, that's right. So, okay. There's a physical property of gasoline called Reed vapor pressure, or RVP. And basically it's a measure of the volatility of gasoline, or probably a better way to put that is how easy it is for that gasoline to evaporate. Okay. So the higher the Reed vapor pressure, the more evaporative, if you will, the gasoline is. Now, in cold weather, right, you want gasoline that evaporates more easily. The reason is because when you start your car, that gasoline is turned into a gas, right, which combusts in the engine. So if you live in a cold state, let's say you live in, I don't know, somewhere in the upper Midwest where it's really cold in the winter. If your gasoline doesn't have a high enough Reed vapor pressure, then it's going to be difficult for your car to start. And until the engine warms up, it's not going to run efficiently. So in the winter, they do winter blend gasoline, which has a higher Reed vapor pressure. Now, butane, which is a natural gas liquid, has a high Reed vapor pressure. So what refiners do is they blend butane into the gasoline mix. Now, in the summer months, you have the opposite problem. Especially in states like Florida, Texas, California, right? And especially in urban markets, you don't want a high Reed vapor pressure. You want a low Reed vapor pressure, because in a hot market, that gasoline is going to have a tendency to evaporate if you were, for example, driving around with winter blend gasoline in the summer. And what that does is it increases emissions, pollution, things like smog, right? Which are a problem in some of these states, in these warmer states. So they can't blend as much butane in the fuel in the summer as they do in the winter. So butane is a natural gas liquid. It is blended routinely with gasoline. It makes it cheaper to make gasoline because butane is significantly less expensive than oil. Right now, butane trades, right around 80, 85 cents a gallon, which works out to what, $34, $35 a barrel, right? So it's cheaper than oil. So you can blend it with gasoline in the winter and get that high RVP gasoline product at a lower cost. But in the summer, you can't do that. So it's not a choice, right? Right? It's something that, first of all, you wouldn't want to do because, it's going to create a physical property of the oil, which is undesirable, right? And secondly, there are regulations governing, the Reed vapor pressure of the gasoline you produce for the whole country, right? The EPA regulates this, but also for individual markets have more stringent requirements because of primarily their geographic location. For example, Southern California or Miami area, right? They have extra requirements because in the summer because they're so hot, and so you don't want a very evaporative gasoline because it creates pollution. So it's not an option to
So you're
use a
saying
lot more NGLs.
So if I could summarize, and you provided excellent details here of the refining process for our listeners out there. If I could summarize some of this, it basically means that some of the stuff that Doomberg said to transition to solely natural gas liquids, and eliminating oil demand to make gasoline and other products, it's not economic. And the refiners, I mean, there's less refiners anyway. A lot of the California is shutting down refineries.
Yes.
These refiners, it doesn't make any economic sense for them to do that. Now they can blend in maybe some of this stuff in seasonality, but they can't do a full transition. And even if they did, they would drive up the price and it wouldn't be economic to do the substitution for long.
Right. And, I think one of the things that I think we discussed via email, and also it's something that Doomberg brought up in one of his Substack articles, was this, this Fischer-Tropsch process, right? FT process, which, was used by both the Nazi Germany, right? And also South Africa during the apartheid years, right?
Well, Sasol, right? It was invented by, I
Sasol.
think, Sasol, which is they're publicly traded.
Yeah, well, it was actually originally invented in Germany, literally during World War II. And the reason that they used it in Germany and the reason they used it in South Africa is because for different reasons, right? In the case of Germany, obviously because of the war, and in the case of South Africa, because of sanctions related to apartheid, right? They weren't able to get easy access to oil supply to make gasoline and diesel. So they came up with a way of making gasoline and diesel out of coal, right? Or also you can use a similar process to make it out of natural gas or natural gas liquids, other hydrocarbons. But it's extremely expensive and extremely energy intensive. And the only reason that you would do it is if you don't have access to be able to import or produce enough oil to meet your needs. It wouldn't be, again, it's not a choice.
So you're saying it's too expensive. It's not really economic. So if you have heavy sour crude from Venezuela or Canada, or you have light sweet crude to blend, it's way cheaper. The input costs are way cheaper to do that than Fisher Tropic and coal to liquid or natural gas to liquid then.
Right. The only places that, for example, right now, look around the world, there's a lot of LNG plants being developed. And LNG is not a chemical process like Fischer Tropsch, right? All it is it's a cryogenic process. You're cooling natural gas to negative 260 degrees.
You're making it smaller. Yeah, you're
making it smaller and turning it into a liquid, right? From a gas to a liquid. But it's not because you want to feed that liquid into your car or a truck or anything like that. It's because you want to store it so you can ship it to other countries, right? Where it's then regasified and put into the natural gas pipeline network.
It's an arbitrage of price. So you're taking the cheap natural gas here in the United States and you're arbitraging it. Yeah, you're doing all the technology and the liquefied natural gas transports, right, but it's still arbitrage. So you're taking the $1.80 price or whatever you can get around there here, or whatever that it's hedged at here, and then you're selling it at a large profit in another market, say European Union or Asia.
Right, and there's a little bit of a cost for liquefying the gas, and there's a little bit of a cost for regasifying it. But as long as the cost of the feed gas plus those costs is less than, say $8 now, it's economically very feasible to do. But you're not chemically changing the gas. All you're doing is cooling methane down. Fischer Tropsch, you're chemically changing the gas into another commodity, or you're chemically changing gas produced from burning coal or transforming coal into a liquid fuel like oil.
Or diesel, yeah.
Yeah, and so that's a very much more expensive process than LNG. As a result, you look around the world, theoretically, if you could easily convert natural gas into oil cheaply, right, you would do that, right, instead of making LNG, right? Or at least some people would choose to do that.
It would be cheaper to transport it, yeah.
Yeah, it would be cheaper to transport it. It's a higher value commodity. And, companies would decide to do that instead of, for example, making LNG and exporting natural gas as natural gas, or at least part of their production. But the only countries that are really doing it right now, Qatar, they have a project, which I believe they work with Shell on, that does produce gas to liquids. But that's because they have this huge north field there, which is totally stranded. It's nowhere, they can't export it as LNG. And they give the gas to this gas to liquids plant for free, right? Basically, the gas is so worthless in any other way that they can make it work with this process. But that plant was tens of billions of dollars to construct, and it would not be economic even at low natural gas prices. Almost anywhere else in the world, under almost any circumstance. You'd have to see oil prices, well north of $150 a barrel for that to start to make enough sense that people would be willing to take a risk on something like that. So, it's possible. A lot of things are possible, but it doesn't make any sense. And so I don't think it's something that you're going to see widely done. And even if it were theoretically possible, right, to some technological advancement made it possible to convert all these natural gas liquids into oil. Right now, there's just not enough supply of natural gas liquids to to fill in the levels of crude oil displacement that he's talking about.
Well, also the U.S. has by far the abundance of natural gas and natural gas liquids, so the U.S. would be the only one who would be able to do it.
Yeah, the U.S. would be the only one able to do it, and I mean, right now we are actually exporting. That's another thing. We actually export already ethane and propane, right, to other countries. For example, a lot of the ethane we produce in the United States gets exported to China, where they use it to make plastic, right, and chemicals. And we also export propane, for example, to India, right, where they're using it to displace, traditional wood and biomass, as a cooking fuel and a heating fuel. So, yeah, I mean, these technologies exist, but converting natural gas liquids into LPG, liquefied petroleum gas, and exporting them in that manner, which is already a widely used technology, similar to LNG, but it's a different type of hydrocarbon. I mean, that's how it's being done. I don't see any reason that people would stop doing that, because that's the cheapest and most economic and profitable way of exporting those hydrocarbons.
It also sounds like the refiners don't want to be making very large capex investments into investing in this type of technology, because they can get cheaper oil inputs or other liquid fuel inputs there, and maybe just blend in the other stuff into there.
Yeah, I mean, and look, I mean, if you spend any time looking at the refiners or listening to their calls and all that, I mean, you'll hear what they're talking about. I mean, the story with the refiners is something you mentioned earlier, which is that the capacity here in the U.S. and all around the world is going down, and particularly in Europe and the United States. Refineries are being closed down in states like California, all across Europe. In Europe and California, part of it's due to environmental regulations, but part of it's also due to the high cost of natural gas. Natural gas is used in the refining process not to create gasoline, but to heat up and cool down crude oil. Right? It's used as an energy source in the refining process. It's the second largest raw material cost, other than oil, right? To make gasoline, you have to heat up oil and cool it down. That's all refining is. And it's hard. And so, European refineries at $8, $9, $10 gas just aren't profitable.
Yep.
U.S. refiners, at $1.85 are, right? It's very profitable.
Well, Germany had to close their fertilizer plants too, because natural gas prices were too high. So the natural gas input costs from importing it, because they don't have domestic supply, were so high that they had to close down with their refineries, like you said, and also their fertilizer companies, and that hurt
fertilizer companies, chemical companies. All these things use natural gas or natural gas liquids as feedstock or as a source of energy. And energy costs there are too high to make that viable. So they have to close down. And so we've seen 9 refineries in Europe close down since the end of 2020. That's well over 1 million barrels a day of refining capacity. The United States, we've seen a number of refineries close down, also close to 1 million barrels a day of lost capacity. A lot of it is in California, but we've seen it nationally. So that means that, and as I said, in Europe, it's a lot higher. So refining margins, I believe, are going to be higher than they've been generally over the next several years, because it's not about a shortage of oil, but it's about the shortage of capacity to convert that oil into usable products like gasoline and diesel. And there just isn't enough capacity out there.
Sounds like Valero has an opportunity then, or some of these other refiners in the U.S. I think there was a mergers and acquisitions boom.
Yeah.
Over the last 6 or 7 years, there was a large consolidation, because there's not going to be a lot of new refiners built, that the companies that already own existing refiners have a big advantage then.
They do. And, what they can do is, even though there haven't been a lot of new refineries built in the U.S. since, the 60s, but, refineries have expanded their capacity on their existing sites. And in some states like Texas, that's, relatively easier to do, right? So, these companies can expand their throughput a little bit, even without building a brand new, refinery system. And they're doing that. But, you look at a company like Valero, I mean, they're not talking about increasing their use of NGLs. They're talking about keeping their CapEx, their capital spending below $2 billion a year so they can generate, $6 billion of free cash flow a year and pay a dividend and buy back stock. I mean, literally, that's what they talk about on every one of their calls. And I mean, I think that's great for shareholders, right? But the idea that there's some massive change underway in the way refineries operate or their feedstock, or some technological advancement going on there. I mean, that's just not the story, and it's just not the case.
Yeah, especially unless they were actually going to build brand new state-of-the-art refineries that could efficiently do this type of conversion. But the investment's not there. They're not spending, the oil companies or the government are not spending tens of billions of dollars to build new oil refineries that can do this type of energy conversion from natural gas liquid to liquid fuels easily and efficiently. It's not there.
It's not there. And I mean, doing that first of all, with a relatively new technology like that, I mean, it's not a new technology. We've talked about it. I mean, it's developed back in the 20s and 30s, but a large scale modern plant. I'm not talking about what Sasol was doing in the 70s and 80s, but a large scale modern plant would be a relatively new thing, right? And so the costs would be very high because you would be basically experimenting with a brand new technology. And I just don't see any of these companies, and I'm talking about the independent guys like Valero or Marathon, or the super majors like Chevron and Exxon doing that. I mean, they've got other spending priorities. They're focused totally on LNG or producing traditional hydrocarbons and trying to maximize the cash flow from their refineries. I mean, they're not talking about some major growth or expansion. They're talking about maximizing cash flow, free cash flow, things of that nature.
And the government's not talking about allocating that for energy investments either. So a lot of these governments in the US and Europe are still talking about wind, solar, electric vehicles. Yeah. They're just starting to talk about nuclear power plants again. So they're not talking about those types of like tens of billions or $100 billion of investment in oil refineries. No one's talking about that. Well, other than maybe China, because I think Saudi Arabia and Russia are building refineries in China, but I don't know if they're going to be doing those types of energy conversions.
Yeah, I mean, for the most part, they aren't. I mean, Saudi Arabia, they are developing their gas, right? But they're not really looking at it for export, but they're looking at it for domestic energy use. So right now, Saudi Arabia burns a ton of oil, right, to create power, electric power, and they would rather export that oil. And so they're trying to develop their gas so that they can use the gas to produce power and then export and increase their oil exports. And so, I mean, by 2030, right, they think that they can free up as much as another 1 million barrels a day of oil exports, not oil production. It wouldn't be new production. It would just be, instead of burning it up in domestic electricity production, they would use it, they could export it. So they're doing things like that to increase their capacity, so they can export more oil and serve the local market. But nobody's talking about, some major demonstration project to produce massive amounts of oil-like products from natural gas liquids. I mean, or gas. It's just not. I think that at its heart, a lot of people who are talking about this are basically confusing a few different trends. One is that the EIA, certain types of natural gas liquids, particularly natural gasoline and condensate, so these are heavier natural gas liquids, producers have been blending them with oil for many, many years now. But, right, the EIA was sort of improperly accounting for that supply. So their numbers on U.S. oil production and U.S. oil supply and demand were off, because they were improperly accounting for these companies' ability to take these heavier natural gas liquids and put them in the oil. So last year, they added a new series on their monthly reports to account for that. But they're accounting for something that already was underway. They're just changing their numbers, the way that they measure it. I think has caused some confusion, and people think this is a sudden change, but it's not. It's a sudden change in the way the government accounts for production, not a change in the way it's been done for literally decades. And the other thing is, I think some people conflate the idea of using butane to make gasoline as I said, particularly in the winter months, right? With that being, a new source of gasoline supply. It's not. It's a seasonal effect. It's something that's been going on for a long time. Refiners will blend in natural gas liquids just as part of, their normal course of business. It's nothing new, and they're not, chemically altering butane to make it oil, right? So I think there's just a lot of confusion out there, and the idea that this is a headwind for oil prices, anytime in the foreseeable future, I mean, it just doesn't add up.
Well, especially because a lot of these OPEC countries are not meeting their production quota. I think only Iran was actually increasing their production substantially out of all the other OPEC countries. And then we have the Occidental Petroleum CEO talking about potential oil shortages over the next 1, 2, or 3 years because of the lack of investment, that not in the next 6 months or 12 months, there's going to be oil shortages, but over 2 or 3 years, there could be, because they think the Permian's going to tap out and OPEC is not, a lot of these other OPEC countries are not growing production.
Right. And I think they're exactly right. I think that I've been saying this for a while. I think the Permian Basin is, I don't think we've peaked there per se yet, but I think that we're a lot closer to a peak level of production from that field than most people fully appreciate. I think that the Saudis, for example, know that, right? Which is why they're not particularly concerned about, surging U.S. production offsetting, their export demand longer term. And so I think that what you're going to see there is similar to what you see in every oil field that's ever been produced anywhere in the world. At some point, it's going to kind of hit a plateau. And, these companies are the big companies that are going to own most of the Permian, right? Let's face it, Chevron, Exxon, et cetera. And some of the big independents like, Diamondback or, names like that, they're going to be producing this oil at a measured pace, trying to kind of maintain their production to generate free cash flow even at low oil prices. And they're going to kind of plateau production probably for many years. But, the idea that you're going to see the level of growth we saw, say, between 2010 and 2011 and 2015, 2016, 2017, I mean, I just think that's ludicrous.
Yeah, I agree. I think it's kind of Christine Guerrero has described it as a treadmill now. So they have to spend more and more CapEx to maintain production levels or slightly grow it. So the return on investment, it's not all the tier one acreage, the sweet spots. Those are being diminished. We're going to run out of tier one acreage. I don't know if it's in a year or 2 years, but eventually we will run out of it. And then the tier two acreage, those depletion rates, it's not as good as the tier one. And then the field starts to plateau, like you said. So, and then you're spending higher and higher capital expenditure, CapEx bills in an environment where there's higher interest rates. So the oil companies like Chevron and Exxon Mobil, they're not going to be spending like crazy on that. And I think that's what you're seeing with some of the capital allocation now. You're seeing more mergers and acquisitions. I want to get your thoughts, though, as we wrap up the interview here, because there's all this craziness the last couple of weeks. I mean, I've seen just tons of rumors. Is ExxonMobil going to cancel their Pioneer? Are they going to pay $1 billion or $2 billion to get out of their Pioneer acquisition deal, and then they're going to take over? They're going to block Chevron from buying Hess Oil, what they have a right of first refusal. Do you think that all this stuff is potentially could happen, or do you think that this is just kind of like they're playing leverage here to force a higher price, or what do you think's going on?
Well, first of all, I mean, so Exxon and CNOOC, which is China National Offshore Oil Company, they do have a right of first refusal on Hess's 30% stake in the Stabroek block. But the way that contract is, or the way that agreement is written, it's unclear. In other words, if Hess went out and said, okay, we're Hess, but we want to sell just our stake in this block to another company, say Chevron, that would definitely trigger that right of first refusal. But it's unclear. In other words, Hess is being acquired by Chevron in its entirety and will continue to exist, right? Only as a fully owned subsidiary of Chevron. So it's a change of control, not the sale of just that stake, right? So that may seem like a sort of unimportant distinction, but it's not at all clear that the right of first refusal would apply to a change of control. It definitely would apply to, if Hess just wanted to sell its stake in the block to a third party, right? There are myriad problems with that. So first of all, Chevron thinks that it doesn't apply. Exxon and CNOC think that it does apply. So if they don't agree, then what can happen is it could go to arbitration, which could potentially delay the deal until 2025, well into 2025. And so, and if Exxon won, right, probably the deal with Chevron wouldn't go through, right? The Hess Chevron deal would be terminated. And, maybe Exxon would want to buy Hess outright or something like that. But, it would take a long time for that to happen. The other issue, which I was reading about just the other day, is that Exxon's acquisition agreement with Pioneer, right, includes a clause that says that while this deal, before this deal closes, right, Exxon basically can't go out and make another acquisition, right, of that size.
Oh, interesting.
Right. So any acquisition that they might make while the Pioneer deal is underway, right, it can't threaten in any way the potential or likelihood that the Pioneer deal would close. Now, it would be very difficult for Exxon to say, well, we're going to go ahead and acquire Hess. We're going to put out a competing bid for Hess, but that has no effect on our ability to acquire Pioneer because these are two massive deals, right? So that would definitely affect their ability to close the Pioneer deal. Also, because both of those deals are being reviewed by the Federal Trade Commission for antitrust, right? You could say that, well, them acquiring Pioneer might be okay. Them acquiring Hess and Pioneer, that's more likely to have an antitrust concern, right? Or it's going to take longer. So, basically, Exxon announced its acquisition of Pioneer before Chevron agreed to buy Hess, but by agreeing to acquire Pioneer, they basically forego their right to make any large acquisitions or significant acquisitions until the Pioneer deal closes.
So you're saying they couldn't pay, I think there's $1 billion termination fee that they wouldn't be able to trigger that and pay Pioneer $1 billion to walk away and then go buy Hess, that they wouldn't meet the clauses to.
No,
they
could do that. They could walk away from the Pioneer deal, which I don't think they want to do because they also want that acreage in the Permian. But they would have to pay the breakup fee with Pioneer and then go after Hess separately. And to me, like, one possible explanation is that they hope that they can delay the Hess Chevron closing a little bit more until after they're able to close the Pioneer deal. And then they would no longer be prohibited from making an acquisition, and then they could make a competing offer for Hess. That's one explanation I've heard. But I actually think it's very unlikely that they're going to press the issue that much. Chevron, they filed an S-4 statement with the SEC a few days ago. I think, I don't know, the 6th of March or 5th of March. And they said in that they are in conversations with Exxon and CNNOC, right? And so there's been a lot of, they call it a constructive discussion. And they believe that discussion will result in an outcome that won't delay their acquisition of Hess. So, they sound pretty confident in their filings that it's not going to ultimately be a problem. So I still think it's a very low risk event. One more wrinkle in all this is that even if they go through the arbitration, right, and they're found to actually have the right of first refusal, right, they would have to pay what's called a gross up, right, of taxes to the U.S. government, which could be as much as $12 billion. I don't think that either Exxon or CNOC wants to pay $12 billion to try to buy that asset from Hess. So there's a lot of there are a lot of complications with this whole thing.
Yeah, there's a lot of lawyers involved, and it sounds like there was like poison pills and right of first refusals. Would the Pioneer deal close first? So is that deal gonna get approved in the next couple quarters and close first then?
Yeah, I mean, I think the Pioneer, both the Pioneer deal and the Hess deal are being examined by the Federal Trade Commission. The general feeling is that there's really no antitrust concerns with either one of those deals because, I mean, the oil market's it's a huge market. Even with these acquisitions, obviously, both these companies aren't going to control a significant portion of the global oil market. It's very hard to say that there's some sort of antitrust concern. So, it's always possible that it could be delayed a little bit. But yeah, I mean, my guess is that the Pioneer deal ultimately will be okayed, and that that could happen as soon as sort of the middle of this year. And the Chevron deal is basically those two deals happened just a couple weeks apart, so it would be in a similar time frame. And the one explanation I've heard is that Exxon may want to try to delay the Chevron deal a little bit with this arbitration, so that then they would have an opportunity to close Pioneer and then try to make a separate bid for Hess. That might make some sense. That's the only explanation I've heard that makes a whole lot of sense. Are they going to pay the termination fee and walk away from Pioneer? I mean, I don't think so. I mean, after all, they could have offered to acquire Hess on their own if they'd wanted to, right? I mean, the transactions are about the same price point. So they certainly could have gone. I mean, Exxon certainly could have gone to Hess, right, instead of Pioneer, and worked a deal to buy it outright. But they didn't. They chose to go after Pioneer. So, obviously they want those assets too.
Because they already have so much of the deep water offshore blocks in Guyana, right? So they're saying like, well, the Hess oil stake, we already have a lot of that. We don't need the whole thing. We may as well add more tier 1 acreage in the Permian.
Yeah, I mean, that's part of it, but they also said publicly, as has CNOC, that they would be interested in acquiring the Hess stake, right? Or they'd be interested in acquiring a larger share of the block. Both companies have said that because it's considered, one of the premier assets anywhere in the world. So they've both said that for years, right? But Hess hasn't been interested in selling because they also, realize the value of it. Yeah, I mean, I think they want it, but obviously they didn't want it that much more than Pioneer, or they would have gone after, Hess first. Whether they ultimately will want to try to acquire Hess too, I don't know. But, I will say that the wording of that S4 statement with Chevron suggests that, maybe they're going to come to some sort of an arrangement, privately, right? Without going through arbitration.
Oh, I see. Yeah, because then that delays things. There's extra lawyer fees. There could be counter lawsuits. I mean, you don't want a bidding war scenario where I think it was Chevron and Occidental Petroleum. Chevron just walked away. Chevron got $1 billion, I think, for walking away, and then Occidental Petroleum leveraged their balance sheet with a lot of debt to do an acquisition. This was before the pandemic.
Mm-hmm. Yes, that's correct. They bought Anadarko. Chevron came out with the offer first, and then Anadarko came out with a bigger offer for the same assets, and they walked away they paid the breakup fee and walked away. But this is
Warren Buffett. It was Occidental Petroleum, right? Because Warren Buffett was giving them the funding.
yeah. Occidental Petroleum is basically trying to acquire a very large company for them, Anadarko. For Chevron, it would have been a much easier purchase to close, but Occidental obviously really wanted the assets. They borrowed money from Warren Buffett. They borrowed a lot of money on the from banks, bond issues and whatnot. And unfortunately, their timing wasn't great because that was 2019, and then a few months later, the commodity market just kind of blew up, and there were concerns about Occidental's debt load and all the rest of it. But ultimately, they have they've managed through it, and I think it was a good deal in the end. I mean, it does happen, and I'm not saying it won't, but I do think it's interesting that their existing deal with Pioneer means that they can't make an offer for Hess unless they terminate, right? Unless they terminate their existing agreement with Pioneer. And again, obviously they want Pioneer because they offered to acquire Pioneer first.
So it's still too early then to see how some of these deals with Pioneer and Hess Oil, how things will finish. But Elliott, you gave the probabilities of what's most likely to happen. But if I were to look at just valuations on free cash flow of some of these companies, there is a lot of US and Canadian oil producers. Most of them are small caps and mid tiers. They're selling at 30%, between 30% and 50% discount to net asset value. And you're starting to see, more astute investors, whether that's Warren Buffett adding more shares with Occidental Petroleum, and he keeps increasing his stake, it seems, every couple of months, or Stanley Druckenmiller, who's a very astute hedge fund manager. He's been selling his tech stocks like NVIDIA and others. He was in artificial intelligence and tech stocks a couple of years ago. He's now buying oil and energy companies now as a value play.
Yeah, I mean, we recommended in Energy and Income Advisor actually both Pioneer and Hess when they were acquired in October, and we've advised just staying with it because Exxon is actually one of my favorite. It's my favorite of the super majors. I think I've talked about it before on the show, but basically they have the best production growth profile out there. I think they got Pioneer at a good price for them. And, I think long term, they're going to do a lot better than any of the European super majors. And frankly, they have a better production growth profile than Chevron. Hess, I mean, from a Hess shareholder standpoint, most of the outcomes from all this are good, right? If the deal with Chevron is terminated and Exxon agrees to acquire them at a higher price, then they get a higher price for their assets. If Exxon doesn't want to acquire them, but just wants to block the Chevron deal, then everybody knows, even it's more visible, even more how valuable that Guyana asset is, right? I think both those companies are in good place. I think that a lot of the smaller producers, as you mentioned, are trading. If you use a reasonable long-term assumption for oil and gas prices, a lot of these companies are trading at large discounts to what I think they're worth on a discounted cash flow basis. I mean, Chesapeake, which is trading in the 80s now, my discounted cash flow valuation for that company is somewhere around $120 a share, and that is assuming that the strip price for gas over the next couple of years, and then gas prices averaging around $4. So you're almost a 50% discount to that right now.
And they're pretty large. I mean, there's Canadian ones that are selling like Surge Energy. I don't know if you cover some of the smaller and mid-sized Canadian ones like Surge Energy and some of the other ones. They're selling at even larger discounts than that. And Canada's building the pipeline where the oil was landlocked, and now it's going to get to the coast. So they're going to get a higher price for that oil.
Yeah, I don't cover all the smaller ones in Canada, but I think there's generally a lot of value out there on the U.S. and Canadian side because I think the main reason is that a lot of investors will look at the price of gas and say, okay, natural gas is under $2 a million BTUs. It's at like 20-year lows or near it. So why would I want to own a company that produces natural gas? But what they're ignoring is the price of gas for delivery early next year is more like $3.50, right? Which is a very comfortable level. And over the next few years, with US LNG exports growing, gas prices are likely to be a lot higher on average. So these companies are kind of, hidden cash cows, if you will. People look at the front month price of gas, which is almost totally irrelevant, and don't recognize the longer term value. And so I think there's a disconnect there. On the oil side, the energy sector is very much out of favor, has been for years. And so these companies are trading at extraordinarily low valuations compared to almost any other sector in the market. And that's true again in Canada too. So yeah, I think there's a lot of values out there because the sector is just so far out of favor, and commodity prices look low, right, on the surface. But I mean, I think cash flow counts, and cash flow eventually will out. You have a company generating billions of dollars of free cash flow a year, as Chesapeake was likely to do in the next few years, paying out dividends of, 10, 15, 20% with cash flow, at levels that we saw, say, last year or in 2022. I mean, it's hard for investors to ignore that over the long haul. And so I think that a lot of these valuation gaps are going to close.
Yeah, I agree. There's a lot of oil producers out there that have dividend yields above 4%. Their balance
Yeah.
sheets are a lot better than a couple of years ago. They have free cash flow. The management teams are talking about they're not wasting a ton of capital. So they're focusing on good profit margins, cutting costs, free cash flow. They're saying the right stuff. And the question then is if they execute the strategy and focus on profit margins and free cash flow, share buybacks if the stock is cheap on a valuation. And over time, in the short term, those valuations and the stock price may not go up, but over the long term, if the management team keeps doing the right things, I mean, it will be rewarded, I think, or the company will get bought.
Yeah, I mean, for example, right now you can go out and you can buy Exxon and get a 3.5% yield, right? So I mean, even like the big names, you can get these, pretty impressive yields, just because the sector's so far out of favor. I mean, a lot of the refiners I cover, Valero, they yield, close to 3%, and they've, over the last couple of years, they've bought back, a significant portion of their outstanding capitalization. I think in Valero's case, somewhere around 20% of their share count they've bought back. So yeah, there's a ton of value there. They're returning a lot of value to shareholders, and if commodity prices normalize, as I expect over time, particularly on the gas side, honestly. There's an awful lot of upside in those names. I think that there's an awful lot of value out there.
Yeah, oil stocks are definitely cheap, hated. They're contrarian value. If you look at the hedge fund ownership of the oil companies, I mean, it's at a 5-year low. So from a value investment, from a contrarian company valuations, I mean, they're cheap and they're hated, and there's bargains there if you're patient.
I totally agree. And I think longer term, I mean, you also have to look at, the energy sector. Right now, the S&P 500 energy sector is, right around 3.75 or 4% of the S&P 500 by market cap. Back in the height of the boom years, right, it was more like 12, 15%, right? It's absolutely inconceivable, in my view, that a sector. So if we do have, as I expect, sort of a super cycle in energy prices over the next few years, where oil prices are generally higher than they have been, gas prices recover, it's inconceivable to me that a sector that is basically manages all of that, the lifeblood of the U.S. and global economy, right, could be just less than 4% of the S&P 500. I mean, that just doesn't add up.
Well, it doesn't add up to the profits and the free cash flow, right? So for the S&P 500, doesn't the oil and energy industry generates like over 10% of the profits and the free cash flow, but the market caps are distorted from that?
Right. And, you look at technology and, it punches above its weight. So its weight in the S&P 500 is something like 30%, but it generates, right, I believe around 20% or a little over 20% of the S&P 500 profits, right? And the energy sector is the opposite. It's punching, it's an underachiever, if you will. It's punching way below its actual profits. And, again, I mean, we're talking about the need for trillions of dollars in investment in exploration and development of new oil and gas fields around the world over the next, 5 years, right, to 2030, right, to 6 years, and we're talking about companies which are relatively small in comparison to the S&P 500, right? Exxon is the largest by far energy company in the U.S. I mean, it's something like $450 billion company, right? So it's small relative to a lot of these tech companies, for example. You're expecting companies like that and the independents, which are even smaller still, of course, to fund all of that capital spending to supply an absolute necessity to the global economy. I mean, it just doesn't add up. So, I mean, longer term, I think these companies are going to have to be, they're going to get bigger. The stocks are going to do well because, that's basically the way capitalism, right, encourages companies to invest in necessary commodities, is by rewarding companies that are producing more of these things with higher profits. I mean, that's just the way it works, right?
Well, also the global economy and for economic growth in a country, it doesn't function without cheap energy and cheap electricity. And as more data centers are built and artificial intelligence, electric vehicles, all these things are planned, they're all assuming that electricity is going to be cheap. So the
Right.
investments need to be made in oil, natural gas, nuclear power. And there's a lot of, I would say, false assumptions being made by the market right now with market cap. And the money's going to have to be invested into energy going forward.
Yeah, I agree. I mean, there has to be a capital spending boom. We saw it in the 70s, and that's what ultimately broke the back of that price spiral. And I think we're going to see it, in the next few years as well, globally, again, because we are entering a phase of the economic cycle where inflation is more of a problem. There's commodity shortages in a lot of different markets. In markets like that, these are the sectors that tend to perform best.
You are a wealth of information on energy, Elliott. I want to thank you so much for your time. I've kept you for over an hour. If my listeners want to check out your newsletter or your Substack, how do they do so?
Okay, well, the newsletter is Energy and Income Advisor. So it's energyandincomeadvisor.com. You can also check me out on Substack. I have a Substack called the Free Market Speculator. So Free Market Speculator at substack.substack.com. And that is actually free. So I post a lot of free content about energy and other things as well, but a lot about energy. So you can check me out there and sign up for to receive that commentary free, usually once or twice a week. Those are probably the easiest ways to get a hold of me. I also, happy to answer any follow-up questions anybody has. My email address is over on my Substack.
And you're also on Twitter. So thank you so much for your time. And I really enjoy our discussions. I always learn a lot. I think my listeners are going to get a lot out of that conversation there about refiners. Looks like there's opportunities for the refining stocks over the next couple of years.
Yeah, I certainly think so. And, thanks for having me on. It's always fun.